Sound is good, everybody? And we will get going for tonight. There's an email that'll be on your way just kind of summarizing some little schedule modifications. I'm going to kind of simplify things. I'm going to do, and some of you have heard this, right? I'm going to do a DTS educational event, which is what tonight is. And I'm going to do that the first Wednesday of every month so you can kind of, get that in your head, set the schedule. And the biweekly scanning evenings will continue approximately every other Monday, occasionally one off and occasionally a holiday, whatever. And then I added something called the impromptu event, which we had one last week. And those are just kind of spontaneous. They're not on the calendar. They 24 or 48 hour notice. And the summary of those is not going to be in video format. It's going to be in email. So the one from last week you'll be getting in email summary. You should have gotten it already, but it's a little behind on it. So you'll probably get that tonight sometime. And then, of course, the events like this, the hour-long events, there'll be a video that gets posted on the free stuff page. All right? So just so we're clear, so tonight is a full-blown, good old-fashioned educational event. And this one is called risk progression. This is one of those topics that is kind of, just unbelievably important. And everybody would say that and understand that. It gets a lot of lip service. Nevertheless, it still becomes one of the biggest things that kills traders. And there's a lot of different ways that it does. And that's why I think it's a very important topic. And it's probably going to be one of the maybe 2 or 3 things I talk about in the upcoming first Platinum members meeting. And tonight, I think a big focus I want to get into is the underlying rationale, which is so important. And to do that, I want to give you an example. Let me just get through the opening slide here. Today, December 6th. You've read that in the email if you wanted to read it. If not, that's okay. Anything on there I want to say? No, 2 parts. So I'm going to take the first part and just kind of talk about the word risk and risky and what it means because it's an interesting topic. But then I want to kind of fly through those slides pretty quickly. I did a similar thing a couple of years ago. And then I want to get to the real heart of it, which is to talk about risk progression, which is the topic for tonight. This is very similar to me to the concept of stop losses. When somebody has a serious problem because they didn't adhere to a stop loss, is it A, they just couldn't figure out how to do it mechanically, they didn't have the brain power, didn't understand it, or B, they knew what to do, they just really didn't want to do it for some reason or another? It's kind of a softball question, but I want to see who's participating out there. And please stick with me on this. I know some of you, it's just this give me this charts attitude type of thing, and it doesn't work though. And what's important about some of these presentations is that you will do better if you understand what the problem is, because it's not just a matter of, do it. It's just kind of like dieting, You could say, just do it, but people don't, right? But if they get an understanding of what's going on, they have a better chance of doing it, right? When you ask yourself how many people then have a serious problem because they didn't use a stop loss, or how many people have a problem because they did stop out of something and they keep saying I'm going to fix it. In other words, sometimes people look back and they say, I'm using stops and I'm following them, but these stops are killing me because every time I get out, the trade works afterwards. And they keep saying they're going to fix it, adjust it, but they never ever do. What I try to do to help people understand that is to go through the process of saying, all right, when you have a stop, I'm sure all of us at some point have had a situation where we've been underwater more than we should have, right? Everybody's had that. So what I always ask everybody is, well, when you are down more money than you should be and you refuse to exit the position, what is your mind thinking? What's the rationale? I don't want to ask you because this is just kind of an example of what tonight wants to bring up. And the answers are always, well, I didn't get out because, if I get out here, I'm sure it's going to rally from here if I was long, right? I'm sure I'm going to get out right at the low, so I'm just going to hang in there. Or the other reason is, it's just too much money to lose, right? I can't lose. I have to wait till it comes back some. And what is ironic is, of course, is that you don't realize it, is that all the reasons you have, all the rationale you have, whether it's well-founded or not, and it's not, it gets exponentially stronger the more the stock drops, right? True, whatever your reasons are, if you're down twice what you should be, and you have this rationale about why to hang on, well, that rationale is even stronger if you're down 10 times. True, everyone? So one of the first steps of really getting a handle on some of these things is to understand what the real issue is. When we talk about risk progression, it's the same problem when I get there. And that is that if you really understood the true benefits and detriments, now everybody knows the detriments, and they'll say, oh yeah, Paul, I know, blah, 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 blah. But if you really understand the pluses of it, which is what most people don't, you would change your mind about how you go about things. And that's kind of where I want to lead up to tonight. Why do I bring up a topic like this? I go back to what I say a lot, is that being an instructor this long and talking to so many people, I see the problems that arise all the time. And risk progression is probably, it could be one of the biggest killers, period. Because it's one of those ones that's a little bit superficial, right? I always say if people don't take their stops, at least they know what's wrong, right? It's like you have a broken leg. You can't be walking around and don't know you have a broken leg, right? You know what it is and you say, okay, I won't jump off the house anymore. But the problem is with some other things like risk progression, it's almost like a kind of a silent killer that you're not really even understanding what the problem is. You just think you're trading, you're not trading right, you can't fix it, and you can't figure out why you can't fix it. Well, the problem is often this. So I don't know if any of that made a lot of sense to you, but it will be by the time I'm done. So here's an opening question. I just want to deal with this topic first because this one always bothers me too. Wow, that trade was really risky. What does that mean exactly? Somebody want to give me a couple answers to that? When I say, oh, I'm not going to take a trade that's too risky, or oh, that trade you took was really risky, what does that mean? Seriously. I mean, I hear this all the time, right? If I'm at events like this and I show somebody a chart and I say, well, would you short that here? They would say, oh, that's really risky. Okay, well, you're interjecting some facts in this, Robert, because I show somebody a trade and I say, you know, here, what do you think of this? And they say, oh, that's too risky. Well, I didn't even talk about how many shares I'm taking or anything, right? They just say it's too risky. Well, Art, I mean, you could buy one share. And Carmen had an answer that is very common, right, is to say it's lower odds. But does that make it risky because it's lower odds? The bottom line is that I don't know what that means. You know, when people say this to me, it has no meaning at all in trading. And here's why. Does it mean that you lose too much money, right? That's what some people would say, oh, you're going to lose too much money on that trade. Well, that's a very novice trader talking, right? Because there's no such thing as losing too much money on a trade unless something bizarre happens, which I'll talk about in a minute. There's no way that could be because you define how much money you will lose, right? Not say you want to lose the money, but you define how much money you will lose. And that is what happens unless during the trading day you had a halt, or unless as an overnight position you had a big gap or something. So it's kind of senseless to say that trade is risky because you feel. Now what Robert Wood kind of was right. He said, well, if you take too many shares, I mean, that's interjecting a new thing, then you are, I'm not even sure if risky is the right term really, because if you've decided to risk twice what you normally did, well, you are risking more money, yes, but does that make it risky? Not sure. So it may mean you lose too much money. It better not be, because you can predefine that. And so what do? Do you put a loss limit, like setting an 8% loss limit? The old, some of you that are go back a ways, there's old IBD was so acclaimed for coming up with this, oh, set your loss limit to 8%. That's ridiculous. That's the talk of idiots. Nobody loses 8%, and 8% is a meaningless concept anyhow, because like if you look at charts of Beyond and General Mills, 8% on one chart and 8% on General Mills would take you under last month's low, and 8% on Beyond wouldn't take you back till 3 o'clock in the afternoon. So it's really senseless to talk in that way in terms of what. So when you say something's risky, it cannot mean the amount of money you lose, because we have control over that. Something I'm going to be getting to here in general is that if you have control over it, it's not risky, right? Risk involves things you don't have control over. So when we say you may lose too much money, not the case. And just a quick slide here for those of you who don't know, it's just math. We take our trades from a chart and we determine where the chart will say, hey, this trader is no longer working. If I'm long, there's some spot on the chart where I'd have to say, you know what, this trade just isn't working anymore. If I'm taking an uptrend, if it's now in a down, so there's going to be a number on the chart, and that's based on your strategy, however you trade. You'd say, I'm getting in here, and here's my stop. and then of course you take that stop and you translate it to share size. So I mean, just a simple example, if you're risking $200 and you had a 50-cent stop on the chart, you could take 400 shares because that's just the math of it. So by taking 400 shares, you limit your risk, and you cannot call the trade risky, and you cannot say you're going to lose too much because you've predetermined what you're going to lose. And what Roberts has said here, does risky mean that it has less chance of success, more likely to stop out? Well, again, to me, that's kind of the hallmark question of a novice trader, because does lower odds of success make it a poorer trade? And this is one of the common questions I get if somebody comes to the trading room and they may ask, oh, what's your batting average? Well, who cares? It doesn't matter what your batting average is, it matters if you make money. Is the lower odds of success make it a riskier trade? And the answer to that, if you think about it, is of course not. I mean, just a simple example here. If you make $100 2 out of 3 trades, right? You're batting 66%, congratulations, right? But over 6 trades, you're going to make $200. If you're only batting 50%, somebody'd say you're a poorer trader. But if you make $200 every other trade, well, now you've made $300, right? Or $2,000 and $3,000, or whatever you're risking. It doesn't matter. So just because a trade is more likely to stop does not mean it riskier, because the question is, how much money do you make? And if you know ahead of time that it's more likely to stop, does that mean it's risky? It's not risky. It's not the right use of the word. Risky really, I hope this next slide says this, risky really implies, if you go to the dictionary, it talks a lot about chance of injury, not really on point. Some talk about the chance of loss, but you accept a level of fixed chance ahead of time. It's no longer risk. So you could say an investment has risk because you could lose money, right? All the disclaimers. Risk disclaimer, you could lose money. Okay, but if I know how much money, it's no longer risky. It's just there's risk in everything you do. Anything you do has risk to it. I could get killed going out to eat tonight, right? Driving in my car, drive-by shooting, eat poisonous food, whatever it is. So you're driving 100 miles an hour to get home for your spouse's birthday because you missed it is risky. That's risky because you now introduce the chances of things happening that wouldn't normally happen. The chance of something bad happening dramatically increased, getting a ticket, getting in an accident, getting a collision, loss of injury, loss of life, injury, all that stuff, right? So here's the one that really applies to trading investing. Risk is defined in financial terms as the chance that an outcome or investment's actual gains will differ from the expected outcome or return. Risk includes the possibility of losing some or all of the original investment. Well, under that definition, everything is risky, right? We always may lose, but does that make one investment or trade riskier than the other? What it really comes down to in terms of risk is the unknown in trading. So what is known? We can pass any trade if conditions are not what we expect. This is a huge advantage. We have the ability to say no to any trade. We can define our maximum loss that will incur at the time the trade is not working in most situations. So these things are known to us. What is unknown? Well, if you're holding overnight, for example, here's the first time that I think you can use the word risky or riskier because it has real meaning. When we hold overnight, there is an unknown quantity, right, everybody? If you hold overnight, there is a variable that you have no control over. And that's what makes something risky. It doesn't even make it bad necessarily, but it makes it risky. You could be thinking you're only going to risk $500, but the stock says something bad the next day, and now you've lost $12,000, right? The trade was risky because it was out of your control for a period of time. The same thing would happen to you if you were day trading and a stock was halted. So normal day trading, things don't get halted typically. But if you go after climactic type setups, that is now a riskier trade. Why? Because there is a significant chance now that you've introduced a component called a halt, which would have you in a trade you have no control over. Does this make sense, everyone? This is just kind of a smaller point of what I'm getting to tonight. But averaging down with no plan surrounding it is risky. In other words, there are some traders who, these traders 100% will go broke. It's called a martingale way of trading. It's a martingale way of betting. And what they do is they constantly double their share size as they're losing, with the thought that if you keep your cost down all the time, any small bounce will get you higher. Well, that is risky because there's an unknown there also. That unknown is how long will the stock drop? There's a limit to how much you can tolerate. If you do this type of trading, listen to this comment, there's a 100% chance you will be broke. Not a good chance, not some chance, not depending upon how you hold it, how you handle it. 100% chance you'll be broke if you engage in this martingale type of trading, or you're constantly now. There's a thing called averaging into a trade, and that's not risky because you are always maintaining a fixed loss limit. But when you decide to not have a loss limit and just assume that if you keep adding shares, you will eventually make out well, very, very poor method of doing things. You will be broke. Not risky, any comment that has a defined loss and can be executed, not risky. Margin, people say, oh, I can't use margin, it's risky. It's not risky. You have access to more money. You could make more, you could lose more. It's all defined by you. Same thing. Shorting stocks is not risky. Only idiots talk like that. There's a difference between a bad trader and a risky trader, although they are often the same. Very risky. Buying stocks on rumor, blah, 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 blah. Okay, enough on that. I already talked about IBD, stupid. Long-term trading, you should never lose large amounts of money in any situation. Now, here's where there's a difference between how some people may approach long-term investing and how I do. The typical approach for some people may be to say, hey, I've had this money in bonds, or I just sold my house, time to put it in the market. They put $100,000 in the market. Total risk, totally risky. Why? Because they really don't know where the market's going to go, and they could lose 10, 20% in a month, and they probably wouldn't know how to handle it, and they would just be sitting there watching it go down and down and down. But there are ways that you can invest in the market where it is not risky because you're building into your positions. So everything, risk is a question of the unknown, so to speak, all right? Useless terms. That trade is risky. Doesn't mean anything. Useless term. That trade may lose too much money. You can control how much risk. That's a useless term. Holding overnight is risky, right? So I need to set my risk amount, useful term, right? Setting, following, and understanding why will make or break traders. Let's look at that last comment. So here I want to switch gears to the real meaning of tonight and talk about setting the risk amount and understanding exactly how it is that this is what will make or break traders. Setting, following, and understanding to some degree. Before I get to that, I just want to make this one slide comment here, and that is, do not do multiple things to reduce risk. I've mentioned many times that when I train people, you're trained as a professional trader from day one. Every trick, every quirk, everything that somebody may look at and say, wow, that's risky. But here's the big neutralizing thing. No matter what you're doing, no matter what you're learning, if you start off on paper and then small risk, it neutralizes everything else, right? Whatever else you're doing, whatever kind of fancy type of setup it is, or adding shares, reducing stops, and all that kind of stuff, no matter how fancy it is, and somebody from the outside looks and says, oh, that's a risky way to trade. Well, what's bad is for people to follow stupid, moronic rules like, oh, get your stop to break even as soon as possible. That's for idiots. Oh, don't ever let any profit go negative. Use a bar by bar is the only way to trail because it protects profits quicker. These are all things taught to novices because they lose money and it gets them losing slowly. Well, that's not how you learn how to make money. You do everything the professional way and learn from the beginning, even though it may seem more difficult to learn, but that you learn as a professional. And your one safety net, the one safety net, is you start off with risk progression. That's what it's all about. I can't talk about anything more important than that. It's all about risk progression. So what do you do? And here's what I want to talk about some of these topics a while. You absolutely start off paper trading. Now, this only applies to you if you're new, but here's the little catch. If you're not making money, you're new. So anybody that's struggling or trying to learn or whatever, here's the number one problem that I face all the time, is that, and sorry, but especially men, it is especially men. It's like, well, I'm not going to trade on paper. That's just stupid. That's, I've got to risk a couple $100, do something. With the machoism aside, there is something that you're missing. Forget about, everybody thinks about, oh yeah, the negative, I might lose money if I use real money. Well, I don't care. But you're missing the positive is, and that is the learning process of learning to trade first on paper. This is the bulk of tonight. These next couple of slides I really want to get into is to get you understanding why it is so important to learn to trade properly first and then add money to it. Number one, when you have money attached at all, your brain stops learning from the charts. What do you start thinking about, everybody? When you have money attached, I don't care if you're risking $100, $1,000, when you attach money to a trade, what does your brain start thinking about immediately? Right? You start thinking about the money. You start thinking about, I'm going to lose it, right? You start worrying about the ultimate thing that you are going to be a loser if you lose money, right? Watching the money is what you do, but it's not really because it's the end of your world if you lose $100 or $200 or whatever it is, but it is the end of your world if you can't do this right and you're a loser. Once you lose that money, you're a loser. And this is what really drives people crazy. Now, here's the thing I want you to remember is that you're in a trade. The charts are there teaching you so much, it's ridiculous. If you could just break free, when traders are trading with money on the line, they ignore the chart. They're not following what's going on. They're following the money, and that's all they're doing is looking at that. And they never realize. One of the things I teach in class to students that come, and some of you are DTS seminar program members, one of the assignments I make you do in class 2, Mastering Advanced Tactics, is I teach you what I want you to do is to take a day or 2 days as a day trader and take a position and sit there and stare at it. Just stare at it the entire day, kind of the opposite of what you would normally do. And let the chart teach you. And I teach you to do this with a few shares, just something so you're involved, but so little that you really don't care. And knowing that when you do this exercise, you're going to sit there for 6.5 hours and watch a stock trade, and you're never going to be allowed to do anything with it unless you have such small share size. You're not going to be stopping it out unless you hit your target that you picked. And learn from the chart. Let the chart teach you what's going on, and take notes. Sit there and take notes on it, and say, all right, right here I probably would have got out because it doesn't look like it's going well, right? And then 10 minutes later, or a half hour later, oh boy, you know what? I guess that would have been a mistake. It's doing better now. And here's where I would have sold some for a profit, whatever it is. And then notes later, oh, wow, I guess I cheated to take notes on every thought that you're having and watch the stock all day long. What you can learn from that is absolutely incredible. It's unbelievable. Yet, you know what? The average trader never, ever experiences that. Never. So it's the other side I'm trying to teach you. It's not, oh, yeah, okay, Paul, I know I don't want to lose the money. No. It's with the free and clear mind is when the only time that you can learn what you're supposed to learn. And that's why, when, if you're not in the seminar program, well, you got to figure out what you're doing, but you're never going to figure it out trying to make money while you're trying to learn, right? You'll never make money if you're trying to make money while you're trying to learn. It's a twofold process. So you learn how to trade, you learn how to trade on paper, and these are the things that trading on paper does for you, right? You get to know what you like, right? Now, even if you've been trading for a while, a lot of people just have old habits. There's, oh, yeah, I'll just take any breakout I see or this or that. And maybe if you could paper trade and you can go out and for a couple of weeks just trade anything you see. That's what you should do on paper initially, is just trade anything you see and get to know what it is you like. What's your favorite pitch? What do you like doing? What time frame do you like being on? Do you like breakouts or pullbacks? And maybe you've been a breakout trader, and as you're starting to goof around with other stuff, you realize, man, you know what? Getting in on the bottom of some of these is really the thing to do. And you start, learning different things or whatever it is. It could be the other way. You can start to like breakouts where you didn't like them before, right? And this is where you start to really find out more what you like to do. And this is where you start writing your trading plan, believe it or not. And you don't have to get all hung up on the word trading plan. What you do is, while you're paper trading, you just start taking notes and saying, hey, you know what? I've been on a 5-minute chart goofing around. I really kind of like the 15-minute chart better. Don't stop out as much, have a little more time to do things, blah, 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 bigger targets. And you just start taking these notes. And 15-minute chart, and as you learn, you start saying, well, you know what? I'm going to use a 15-minute chart, but I think maybe I'm going to take my entry from something else or whatever it is. And you start putting these things together, right? The average person never experiences this, right? They don't. And when you start trading for real, that maybe, well, paper trading has a tremendous purpose, and that's great. But the other side of that is just because you make money on paper doesn't guarantee you'll make anything, depending upon how you kind of transition. So naturally, the obvious reason you should start off on paper is because it will also avoid the problem that so many people have, especially men. Sorry, I joke around about this all the time. But so many guys will start off and say, well, you know what, I've got a big account, I'm risk a couple $100, right? So they risk $200, risk $200, and 2 weeks later, they're down $4,000. And I always ask is, men, not women, men only, if you're down $4,000 after 2 weeks and you're clueless, you haven't gotten a trade right, how do you get that money back? Watch this, ladies. Men, how do you get that money back? There's only one way. That's right. You double down, because you'll make the money back twice as fast as you lost, right? And this is how you get big problems. This is how all of a sudden half your account's gone, you don't know what to do. So that's the obvious thing about not starting off, because if you're clueless, but here's the words I always have to you, period, that I say to the seminar students all the time. If you're going to trade the rest of your life or whatever it is, can't you take 2 weeks to prove to me or to prove to yourself that you can make money on paper? Because what if you can't? Just because you can make money on paper doesn't mean you will for real. I'm not saying that. That's not my point of it. The point is, what if you can't? What if even with cheating and starting over and lying, you still can't make money, right? All I'm saying is, hey, at least prove you can do this kindergarten stuff and make money on paper. Yeah, Dave, right here. If you're not making money, you are new. If you are new, this applies to you, right? Right there, absolutely. It doesn't matter where I don't care if you've been trading, and that's something I get so sick of hearing, well, Paul, I've been trading for 10 years. Really? Well, why are you here taking a seminar program? Oh, I haven't made money. Oh, well, then why are you bragging about trading 10 years? What you're saying is, I've been losing money for 10 years, right? So stop what you've been doing. Don't tell me you know what you're doing. Don't tell me you're a good trader. You just had some problems. You stink. Admit it. Go back to square one. So fine, you've been trading, and here's the next point I want to make. You've been trading on paper for a long time, or a short time. Now, I don't recommend trading on paper for a long time. If you're serious about becoming a trader, now for some of you, maybe you're just practicing because you're not ready to trade for a year or two, whatever, that's fine. But if you're serious about moving through the ranks and becoming a trader as quick as possible, paper trade for a couple of weeks. Like if you're day trading, paper trade a couple of weeks full time, whatever it is. Track what you're doing. Set up a goal, prove you can make it, and then when you are ready and you said, okay, I'm a successful paper trader, I'm going to move on, I got some resemblance of a plan, I understand how to execute trades if you're new, et cetera, then here's what I want you to do. Start off with $5 with the goal of going to $10. Now, here again, people are going to say, oh, this is ridiculous, this is not worth it. This step is just such a critical step. And here's a question I want to ask you, and I do this in the apologies if you've been through the intro class slide. I do this in the intro class. Let's say you have a $1 million account, cash or bonds or whatever, right? $1 million. And you just open a $50,000 account to day trade, right? You've been paper trading for a couple of weeks, you're doing well, you feel confident. You take your first trade for $5. I want everybody listening to me answer this question. As the trade starts going and you're up a little bit and then you're down and then it starts to go down, are you going to be freaking out, yes or no? You have $1 million account, you're trading $5 risk, you were up $3 on that $5 risk and now you're about to go down 50 cents. Are you going to be freaking out, yes or no, everybody? Are you going to be freaking out, yes or no? I applaud all of you that are saying no, because you are trying to please the teacher, because you think that my point is that this is why you start off with low limits, right? However, you are incorrect. You'll be freaking out like anyone else. Why? Some of you know. Yeah. Because it's not the money. It's not the money. Okay? Even if 50,000 was all you had to your name, you wouldn't be suicidal over losing $100, right? That's not the point of it. The point of it is this is the first time that you have to call yourself a loser. That's the big deal. So I don't care how much money you have. You've been paper trading, it's on your own records, you can start over, you can cheat, you can say, oh, of course I would have taken that stop, all that good stuff. But now you can't. It's right. It's official. It's on the record books, right? You can't lie about it. If significant other asks how you're doing, you got to pull up an account that says, well, I lost $30 this week and I'm trading $5 risk. Oh boy, you're a big loser. So you're telling me if you were risking $5,000, you'd be down $30,000? Risking a small amount of money is critical because you will be freaking out just from the fact that it's real. So imagine now if you were to take that and if you were to make that $100, $200, $500 risk, now the freak out is incredible. You're defeating the purpose of paper trading. Here are the advantages of this small risk progression, which is kind of what we're getting here to tonight. Here's the advantages of small risk progression. Is that number one we just talked about, fear of losing. The fear of losing is something that's always going to be with you. And the best way to counteract that is to build confidence. And to build confidence, you start off with paper trading and then the confidence to go to $5 and then $10. Now keep in mind, it doesn't mean we're talking a lifetime before you're risking $500, $1,000, whatever. You could progress very quickly. As a matter of fact, right now I have nothing like permanently set up for anybody. I just say, set up a goal for yourself. I don't even care what the goal is. If you hit the goal, move up. I do expect there should be more than a couple of trades, but maybe you could simply set up, if you're risking $5, that as soon as I can make a $20 total in a 3-day period, any 3-day window where I make $20, 4 risk units, right? I'll move up to the next step. Maybe that's your goal. A 4-hour profit. So if you're risking $5, that'd be $20 in a 3-day window as a day trade. You move up to 10, same thing. $40 profit in a 3-day window, and you move up. If you don't hit that goal, you stay there. And if you don't hit that goal for 2 or 3 3-day periods in a row, you move down a level. So that you don't get in this situation, $5 or $10 doesn't matter, but if you get up to maybe 200 too quick, and you can't advance to the next level, well, losing 200 a clip is maybe too much, because just because you're not moving up, 200 may be too much for you at this level. You just got lucky to move up there. So you also have to move backwards if you're not doing it properly. This is what keeps you very safe and keeps you learning. Reason for the small risk amount is because, as I said, if you really keep the risk amount under control where you're never in fear, you really continue to learn from the charts. If you're going to be doing this for a lifetime, can't you ensure a good start by learning properly, learning what you're doing, and then progressing? And then the last thing is the simple math of adding zeros. If you think about it mathematically, if you trade and you're risking $5, and let's just say you have a 5-hour week, say you made $25. Well, theoretically, all you have to do, mathematically, if you don't change what you're doing at all, $50 risk, make $250. $500 risk, you make $2,500 for the week. $1,000 risk, you make $5,000 for the week. You're just adding zeros. That's all there is to it. Now, what 2 things could stop you along the way? 2K risk, 10K. What 2 things will prevent this from happening? It's just math, right, on one hand. So if it's just math, it's true. What could get in the way of that? There's 2 things. One could get in the way at any level, and one could get in the way at a higher level. Yeah. Well, you're all hitting the second one, which I'll talk about. That's the lesser important one. When you start complaining to me that you can't risk $2,000 a trade because of all those reasons, then I'll say, okay, fine. But no, the first, you're missing the point though. The first thing that would stop this math from happening, again, is your psychology, is your fear, right? In other words, you're doing fine, $50, I'm making $250, and you get to 500, and all of a sudden at 500, you're losing. You're losing. How could you be losing? Well, because you look back and you find out you're not managing anything the same. Because a $500 risk all of a sudden is too much, and you're freaking out, and you no longer let stocks get to their target. You very quickly kill something at a smaller loss that turns out to be a winner, right? Do you understand what I'm saying, everybody? That adding zeros mathematically works as long as you adhere to exactly what you are doing at the $5 level, at the $50 level, right? And that's why as you go up the chart, you have to kind of stay at each level a little longer, because you're not going to freak out over $5 or $10 in terms of an increase. But you start getting up to $200, $500, $1,000, you're going to start getting more freaked out. So the number one thing that stops that progression is you changing what you're doing because of the fear of the higher risk amount. Is everybody clear on what I just said, or you want me to repeat that? Again, the line that I just worked up to right now is the whole purpose of tonight, and it's one of the most important things you're going to ever hear. Now, some people don't recognize it. Some of you are here to see some charts. I'll do charts next time. There's not even a chart in this tonight. I was going to put in some gratuitous charts. I was joking around, but there's really nothing that, that I need in a chart to make this point tonight. Not hiding anything. I'm over goal for the week already. Good week, not a problem to hide. Just simply not needed for tonight. I know we all like to see those. I'll promise you next time we'll do something in more charts. But this is the stuff that makes or break traders, right? You sit there and you look at some of my charts and you go, oh, wow, great trade. I'm going to go do that tomorrow. And you think that's the secret. That's not the secret. The second thing then that can't stop you is that you guys are pointing out. You start getting into much higher risk levels, like over $500, $1,000. Then it's possible that share size can become an issue. It depends on how you're trading. Even at $1,000 risk, generally most stocks will not stop you from trading them all out, but it depends how you're trading. Example, and what I mean by that, I have a list of 300 stocks of the higher volume stocks. That's a lot of stocks to look at. And generally speaking, if you're taking your trades off an hourly, 15-minute chart, whatever, it's not going to be an issue because if you're trading a stock and the hourly chart, gives you a 50-cent stop, right? Getting 2,000 shares of a stock is not a problem. Any stock that's on my list there, right? Not a problem. But if you're scalping and you're on a 1-minute chart and you have a 5-cent stop, well, now you need a ton of shares. You probably can't do it, right? So when you really get down to those scalping levels, you have to trade stocks that are very liquid, like BAC and Ford and those type of stocks. You can buy 10, 15,000 shares if you want to, all right? So the math can play in at some point. Depends on how you trade, where it's at some level. But you know what? When you start getting over $500 into $1,000 risk and above that, you're not going to be asking me questions. You're on your own. You're good. Congratulations. What else? For some additional, before I get there, there's one other point in this. Talking about risk progression, moving up, right, from the zero level, psychology, confidence, building your way up, right? But there's a spot where some people do something wrong. And that is that, let's say they're making $200 a day and they're risking $200 a trade. So they're making 1 hour a day. I think a very worthy goal, right? And they want to make 400 a day. That's their goal. Well, what a lot of people do is say, well, I'm going to be very conservative. I'm going to be very risk appropriate, whatever that means. And I'm not going to increase my risk amount anymore above $200. I don't think that's right. I'm going to take twice as many trades to make my $400. What do you think about that concept? Carmen just said no. Exactly. It's the talk of ill-informed people. Because here's your pyramid of trade ideas. I work, however long I work at it, as a day trader, let's say, to go through a whole bunch of stocks and to filter them down and come up with a watch list and then come up with a hot list and then to have that hot list triggered because of the right market timing and the right entry and all that good stuff. And here's my little tip of the iceberg, right? Now I want to double my trades. I got to dip down into this garbage. That's obviously not garbage, but by definition, mathematically, it has to have lower odds, right? It just has to. If I'm a track coach and I have my 6 fastest runners here, here's 1, 2, 3, 4, 5, 6. And if I want to run more runners, to be fair, my average time is going to go down, right? Because instead of the top 3, whatever their average is, I'm diluting it down with the next 3. It's just math, so it has to be the case. So you should continue to work on increasing your risk amount as long as you handle it properly. Whatever level you're at, you continue to do the process of saying, hey, successful trading, the higher level you go up, the more you should wait probably, but successful trading, slowly keep increasing the risk limit, right? So if you want to go from 500 to 1,000, just keep building up 100 at a time, 600, 700, 800. And if you ever notice yourself freaking out because you can't handle the next loss or whatever it is, you went too far, back up and go back again, right? What helps a lot is to always be building up on a profitable bank, right? So if you have a $50,000 account you're playing with and you've built up $10,000, $15,000 profit, you have a little bit more tolerance for a little bit of a losing streak to say, okay, I gave back a couple $1,000, whatever it is, because you have that profit, and you know that you're not going to have all winning trades. If you naturally, if you've worked your way up to higher levels, you should have that profit there. But if for some reason you've worked your way up in a very haphazard way where you really don't have profit, and now you're at a higher level, or you have very little profit, or maybe you have $4,000 profit, all of a sudden you're freaking out about giving back half of that. So you have to be slow with the progression and make sure that it matches your account balance going up and matches your trading capabilities. Does that all make sense, everybody? Part of this discussion is on a Hall of Fame video. If you go to the free stuff page on the Hall of Fame section, there is a video called From Chart Reader to Trader Investor. I haven't listened to it personally. It's a couple years old. It's more than that. It's pretty old. It's from the original year of DTS. But it's still gold on there. And I gave you a summary of it already. But if you want to hear that again or some more detail on that, that is an appropriate additional learning tool for what we're talking about tonight. And set up a formal tracking thing for you, all right? And something I'm going to talk about more probably with Platinum members, is because this is the most important thing, right? Especially if you're trying to learn on your own, right? Is to make sure that you never lose anything significant. You advance upon. So set up your little goals for yourself as you advance through the ranks. So set up a formal concept for yourself, whatever that is. The reason I've never set one up is probably because it's kind of depends on your schedule and what you're doing. Day trading, not trading there once in a while. Maybe you don't have a weekly goal because you're trading 2 days a week, whatever it is. But perhaps what I said, something I think like making 4 R units in any 3-day period, right? Move up. And maybe as you get up higher in the ranks, you got to change a little bit. So that's something I'm going to work on a little bit to help some people who are struggling with that. I am actually finishing up early tonight. Let me know if you guys have any questions. There are, as you know, I've been doing podcasts. Number 17 just was submitted. Number 16 was released last week. I'll give you the links to those. I'll probably send an email. You're going to have a few emails coming over the next few days. Just a couple of educational articles I'm working on, a couple of info things. Episode 16. You can listen to them on a place called Mission Matters where I do them through, or Apple or Spotify. And once you're there, you can find the other 15. If you listen to me a lot, these are not new topics. These are obviously things for people out there that like to listen to podcasts. So you've heard all of this somewhere probably, right? And I'll probably send another email about the Platinum member thing because I want to apologize though in person that I think there was some confusion because I had introduced it at a meeting called The Evolution of DTS a couple weeks ago. And I guess I assume everybody was at the meeting or they saw the video I sent, but a lot of people weren't, and if you're not, it was confusing, so I'll continue to try to clarify that. Are there any questions? Any questions about anything you want to talk about? Bottom line summary from tonight, if you joined a little late, is that this is a topic, just like dieting or just like taking stop losses, where the words are simple, the actions are not. And the actions become simpler if you really understand some of the principles involved. And for risk progression, it's not just a matter of don't lose money. It's the tremendous benefits of being able to learn properly if you start off on paper and then work your way up slowly. Because the antidote, I should have put this on a slide, but the antidote to psychological problems is building confidence by through risk progression, following a plan of what to trade. A plan of strategically what to trade, using risk progression, builds confidence, and totally eliminates psychological issues. That's all there is to it. I did, Robert, but it was worth it. I made like about twice the goal. And that was because, well, we don't need to go into that today. I'm going to write you guys about it in the room. I'm going to write a little thing about summarizing the week. So it was an interesting week. And the reason I did that today is just because of the market. I really had no choice. I got forced to, hang on and see what was happening all the time. And in my initial trades, I ended up managing to partial losses, which turned out to be a good thing to do for the most part. Depends on the trade. So I kept kind of rolling into something different. Anyways. Yeah, I know. Well, that's not the normal, Robert. I don't like doing that. But there are some days where I say in the morning, and today was one of them, I said, hey, I put up the sign, trades will be likely later. Just couldn't really help it. If I jumped risk by so many steps and lost, how can I get back to my base? If I jumped my risk by so many steps and lost, how can I get back to my baseline? Well, what I recommend, Lope, And actually, this is going to be kind of a platinum member topic in a couple weeks when we have our first meeting. I'm not sure if you're, I think you're in that. But just off the cuff, what you want to do is whenever you don't meet your goal, you stay there. But I would say if you don't meet your goal twice in a row, to then come down, right? And keep in mind, while you're doing this goal, you also have to have a loss limit in place, right? You can't work your way up to $100, right? And along the way, have maybe made $400 to get there, and then lose $1,200, risking 100, right? You have to have your loss limits in place along the way too, just per your trading plan. So if you get to a number, you'll say you got up to $100, whatever it was, and you have to have a loss limit. So you're going to say, okay, in any, say you're going in 1 week goals or whatever it is at this point, in any 1 week, I'm not going to lose more than $400, whatever it is. And then if you don't meet your goal 2 weeks in a row, you stay there. If you don't meet your goal any week, you stay there. If you don't meet it 2 weeks in a row, you got to go back down to 50 or whatever it is. And that way, you're very keeping a close reins on a situation where you're kind of never going to go negative, right? The only time you should theoretically go negative, Lope, is when you first start. If you never make money at $5, you should keep losing $5 risk amounts. And if you want to spend $500 with $105 losses, I think by that point you quit or you figure it out. Step one here, I'll go over for all of you. When you're evaluating your stuff, step one is a simple question. Did I do what I was supposed to do, right? You take a trade that you found, you looked for, you did. First question is, does that trade completely represent what it is I want to do in the market? In other words, did I follow my trading plan? If you don't have a trading plan, it's hard to answer that question. Then number two is, if it did follow what I was supposed to do, was the trade managed properly? That's really what it is. This trade that I took, could it have made money had I managed it differently? If the trades are working, then your strategic concept, the things you're looking at, your scanning for stocks is working, and your management's the problem. If, no matter how you managed it, it would have lost just because it was a losing trade from the beginning, well, then you're back to square one, technical analysis. What are you looking at? Why are you looking at those? Change the things you're looking for, right? Get more specific with the setups that you're looking for. If you're on a 5-minute chart and you're taking 5-minute trades, restrict it down to only things that are in 15-minute uptrends or whatever other process you want. Any other questions, anyone? I think what's our next thing at DTS? Well, a week from tonight will be our first platinum meeting if you're platinum. And then, then we're into the holidays. So we have class this week for seminar program members, Mastering Advanced Tactics, this Saturday, and then a week from today is the Platinum member meeting. A week from Saturday is the last class in GAPS, and then we have a week we'll be in the trading room, but then a week and a half vacation for the holidays. And then we're back at the free event on January 10th. Thanks, everyone. In the trading room, I'll see you tomorrow. If you're in class, I'll see you Saturday. And if you're platinum, we'll see you a week from today. If you're a free member, we're not going to see you, I guess, for a little bit. Take care, everybody. Have a good night.